Imagine for a second, right, that you have just experienced this massive, life-altering financial event.
Oh, yeah. The kind everyone always dreams about.
Exactly. Like, let's say you spent the last 2 decades bleeding for a tech startup, and you finally exit.
You sign the papers, and suddenly you are sitting on, what, $50 million in liquid capital?
Yeah, or maybe this scenario is even less expected. You get a phone call from a probate lawyer, and you discover you've just inherited this sprawling, multi-generational estate.
Which means physical properties, operating businesses, and complex trust structures spread across 3 different sovereign jurisdictions.
Right, so the adrenaline is pumping, the reality is kind of setting in, and you have to figure out your very next move.
Right.
Because who do you actually call? You certainly aren't, you're not strolling down to the local commercial bank branch on the corner, walking up to the teller window and asking them to deposit a $50 million wire transfer.
No, absolutely not. I mean, the local branch manager would probably flag your account for suspicious activity before the wire even cleared.
Right, you'd get locked out of your own money.
Exactly. The systems, the compliance frameworks, and frankly, just the personnel at your everyday retail bank, they are simply not equipped to handle that velocity of capital.
Let alone the risks that come with it.
Yeah, that's the bigger issue. They're completely unequipped to manage the immense legal, tax, and frankly, intergenerational liabilities that instantly attach themselves to that kind of wealth.
And that is the perfect entry point for our mission today. We are taking a deep dive into the velvet rope world of private wealth management.
It's a world most people know exists, but very few actually understand.
Totally. And we've got our hands on the actual playbook today. We're using the CFA Institute's Level 3 Private Wealth Curriculum, specifically reading W1, to see exactly how the financial elite insulate, multiply, and transfer their fortunes.
We're basically pulling back the curtain.
Exactly. We're going to look at the architecture of this whole industry. The incredibly complex services these people buy, how the advisors actually get paid, and the massive regulatory nets that have been built to catch the bad actors.
It really is a fascinating ecosystem to dissect. Because, well, when you reach a certain threshold of wealth, your primary objective actually shifts.
Shifts from what? Just making more money.
Yeah, exactly. It moves away from simply generating alpha, just trying to beat the market, to navigating this labyrinth of preservation.
So it's more about not losing it.
Right. It becomes an exercise in mitigating a whole new universe of risks. You're suddenly dealing with currency fluctuations, cross-border tax regimes, catastrophic liability.
Even the psychological impact of wealth on your heirs, right?
I mean, absolutely. The human element is huge.
Okay, so let's unpack the architecture of this industry first. When the average person hears wealth management, they probably just think of a guy in a fancy suit picking stocks.
Right, like a Wall Street broker from the 90s?
Yeah. But looking at the standard industry framework from our sources, stock picking is barely the tip of the iceberg. We are talking about a highly stratified industry with very specific terminology.
Very specific. The industry relies on really rigorous distinctions.
Like, we have private wealth, wealth management, and private banking. Let's lay down those definitions before we get into the mechanics.
Sure. So private wealth is the simplest one. It literally just refers to the underlying assets themselves.
The actual stuff you own.
Exactly. The real estate, the equities, the fixed income, private equity stakes, maybe an art collection. It's the aggregate of what is owned.
Okay, and then wealth management.
Wealth management is the professional service layer applied to those assets. It's inherently holistic. I mean, it marries investment advisory with tax structuring, estate planning, accounting, the whole picture.
So it's the comprehensive strategy applied to the assets.
You nailed it. And then you have private banking, which is slightly different. It often operates as a subset or kind of a parallel track.
How so?
Private banking involves the highly personalized, white glove credit and depository services. It's the specialized lending facilities, multi-currency cash management.
But gate-kept, right?
Ooh, heavily gate-kept. It's merged with investment planning, but specifically reserved for high net worth individuals.
Which brings up, honestly, the most critical concept in this entire framework, the gatekeeping. The industry rigidly segments its clientele.
It's a very distinct pyramid.
Right, there is this strict wealth hierarchy, and the level of service you get is entirely dependent on where you fall on that pyramid.
Definitely.
Now, I know the base of the pyramid is the retail segment. That's generally classified as folks with investable assets under $250,000.
Right, the everyday investor.
And we know they're primarily using passive vehicles, right? Target date funds, standard ETFs. The supplier power of advisors here is pretty low.
Very low. It's highly commoditized.
Then you step up to the affluent tier, which is up to roughly $1 million.
Yeah.
Here you might see um, some basic tax harvesting or retirement plan.
It's been more personalization, yeah.
But the real inflection point where the entire nature of the game changes happens when we cross into the high net worth territory.
Right. That is the crucial threshold. High net worth, or H&W, generally captures clients with investable assets from $1 million up to roughly $30 million.
$30 million. Okay.
Yeah, and at this level, off-the-shelf financial products become entirely inadequate, sometimes even outright detrimental.
Because their financial lives are just too complicated for a standard ETF.
Exactly. These clients require bespoke asset allocation. They might be dealing with, say, concentrated equity positions from an executive compensation package.
So, like if they work at Apple and get paid mostly in Apple stock.
Right, and they can't just sell it all at once. Or maybe they own a mid-sized regional business. The tax implications of every single financial move start to compound significantly at this tier.
And then we hit the absolute apex, the ultra high net worth tier, the UHNW.
The top of the pyramid, north of $30 million.
But what I find fascinating here is that the CFA framework insists that the defining characteristic of the UHNW tier isn't just the sheer number of zeros on the balance sheet.
No, it's not just about the money. It's the complexity. But why is complexity the true metric of wealth management? Like, if I have $50 million sitting in short-term U.S. Treasuries versus $50 million tied up in international real estate and venture capital,
Right.
doesn't the wealth manager charge me the same AUM fee? Do they really treat me differently based on how the money is held?
They treat you fundamentally differently, and the operational infrastructure required to serve you is vastly different.
Really? Even for the same amount of money?
Absolutely.
Yeah.
The client with $50 million in treasuries represents a high dollar value, sure, but exceptionally low complexity. You manage duration risk, you reinvest the yield, and provide basic reporting. It's a very clean, straightforward mandate.
Easy money for the advisor, basically.
Exactly. But let's look at the alternative. Let's imagine a fictional family. We'll call them the Gallaghers.
Okay, the Gallagher.
The Gallagher matriarch built a specialized manufacturing firm headquartered in Germany. The intellectual property for their core technology is held in an Irish holding company.
Yeah, and they own a portfolio of commercial real estate in the United States, and she has 3 adult children who are tax domiciled in the UK, Singapore, and California.
Wow. Just listening to that gives me a headache.
Rightfully so.
Bro.
That $50 million of net worth is a logistical and legal minefield. The wealth manager isn't just picking stocks here.
They're basically running a multinational corporation.
Pretty much. They are navigating 3 different corporate tax regimes, multiple currency exposures, and massive liquidity constraints.
What happens if they need cash fast?
Well, that's exactly the issue. If the Gallagher family suddenly needs $5 million to, say, settle a lawsuit or buy out a partner, you cannot just liquidate a fraction of a private German manufacturing plant overnight.
Right, it's completely illiquid.
So the wealth manager has to engineer a liquidity event without triggering catastrophic tax liabilities across 3 different continents.
Which takes a village, I'm assuming.
A very expensive village. Complexity dictates the level of expertise, the sheer amount of human capital, and the specific ensemble of specialists the firm has to deploy.
So given that immense complexity, it makes sense why traditional firms are pretty insulated at the top. But we have to address the technological elephant in the room here.
AI and the robo-advisors.
Yes. The retail and affluent spaces are currently being flooded by algorithmic asset allocators. They offer tax loss harvesting, automated rebalancing, direct indexing, all for literally basis points on the dollar.
They're incredibly efficient at what they do.
So are these algorithmic platforms moving upmarket? Like, do traditional UHNW wealth managers view AI and robo-advisors as an existential threat, or is it just a tool for them?
It's a phenomenal question. In the retail and lower affluent segments, robo-advisors are an absolute existential threat of substitutes.
Because they're just so cheap.
Yeah, they have completely commoditized basic asset allocation, which drives margins into the floor. A traditional advisor simply cannot compete on price when an algorithm builds and maintains a globally diversified portfolio for 25 basis points.
But the moat holds at the UHNW level. The algorithms aren't coming for the Gallaghers.
The moat is incredibly deep at the UHNW level, and it goes right back to exactly what we just discussed. Complexity.
The human messiness.
Exactly. A large language model, or a robo-advisor, can optimize an equity portfolio based on historical volatility. That's just math.
Right.
But an algorithm cannot sit in a mahogany boardroom with the Gallagher family and mediate a bitter, emotionally charged dispute between three heirs over who gets voting control of the German manufacturing firm.
Yeah. ChatGPT isn't quite ready for family therapy.
Exactly. And an algorithm cannot negotiate a bespoke lending facility secured against a private collection of post-war art while simultaneously ensuring the trust structure complies with both California probate law and the Singaporean tax code.
So the human element is still the main product.
The human element, the high EQ diplomacy, and that multi-jurisdictional legal orchestration remains highly resistant to current automation.
That makes perfect sense. The algorithm can optimize the math, but it can't optimize the family psychology or the legal gray areas.
Precisely.
So if that bespoke human element is the product, let's look at the actual menu of services these UH&W clients are buying.
The service menu is extensive.
We know it starts with what the framework calls core services, right?
Right.
The foundational depository management, liquidity oversight, consolidated reporting.
The basics of keeping the money safe and tracked.
But then we get into lending. And in private banking, lending is not about getting a 30-year fixed mortgage for a summer house in the Hamptons. The framework specifically highlights something called Lombard loans.
Lombard loans are a staple of private banking.
I was looking at the mechanics of this, and from what I understand, this is essentially borrowing against your own portfolio so you don't have to trigger capital gains by selling. Is that right?
That is the fundamental premise, yes. A Lombard loan is a revolving credit facility secured by the client's own liquid investable assets.
Okay, so let's walk through a mathematical hypothetical so you can see if I get this.
Let's hear it.
Let's say I have a $20 million equity portfolio, and it's heavily concentrated in tech stocks that have appreciated massively over the last decade. My cost basis is incredibly low.
Okay, so you have huge unrealized gains.
Right. Now, I decide I want to buy a $5 million yacht. If I liquidate $5 million of that stock, I am instantly hit with long-term capital gains tax.
No, absolutely. Let's say 20% federally plus whatever state taxes apply.
Right, so I could be losing well over $1 million just in tax friction, plus I forfeit all the future compound growth on that $5 million.
The tax friction completely destroys your wealth velocity.
So instead of liquidating, the private bank steps in.
Yes, they extend you a $5 million Lombard loan using your $20 million portfolio as collateral. You get the liquidity to buy the yacht today.
And my portfolio just stays where it is.
Your portfolio remains entirely intact. It continues to compound, and crucially, you have not triggered a taxable event.
Wow.
Furthermore, because the loan is over-collateralized by highly liquid assets, meaning you have way more money than you're borrowing, the bank assumes very little risk.
Which means a low interest rate for me.
An incredibly low interest rate. The internal rate of return on your portfolio will likely outpace the cost of borrowing that $5 million.
It is the ultimate have your cake and eat it too scenario. You literally use your money to borrow money so you never have to actually touch your money.
That's the magic of UH&W lending.
But wait, I have to ask the second order question here. What happens in a 2008-style liquidity crisis?
The downside risk.
Right. Let's say my $20 million tech portfolio drops by 50% in a market crash. It's now worth $10 million. I still owe the bank $5 million. Do billionaires get margin called? Do these Lombard loans become a systemic risk?
They absolutely get margin called. Managing that risk is a massive part of the private banker's daily job.
So how do they manage it?
It's all dictated by the loan-to-value or LTV ratio. If your collateral consists of highly volatile tech equities, the bank isn't going to lend you 90% of its value. They might only offer an LTV of 50%.
Meaning they'll only lend me up to half the value of the portfolio.
Exactly. If the market crashes and your portfolio value breaches that LTV covenant, the bank will immediately issue a margin call.
And then what?
Yeah.
I have to come up with cash.
You must either post additional collateral like inject more cash into the account, or the bank has the absolute legal right to unilaterally liquidate your assets at market bottom to cover the loan.
Which is the absolute worst possible time to sell.
Exactly. It forces a distressed sale and locks in catastrophic losses. This is why wealth managers strictly monitor those LTD ratios and constantly stress test the collateral against severe market drawdowns. They try to ensure the client always maintains a massive buffer.
Okay, so that's the lending side. Let's pivot to the asset management side of the menu. This includes portfolio management and asset allocation.
The core investing function.
Right. But there is a very critical distinction made in the framework between advisory mandates and discretionary mandates. Why is this distinction so important, and how does it change the dynamic between the client and the manager?
It's vital because the distinction dictates who holds the ultimate execution authority.
Okay, break that down.
In an advisory mandate, the wealth manager acts purely as a consultant. They analyze the markets, formulate a strategy, and present recommendations to the client.
But they can't pull the trigger.
They cannot execute a single trade without the client's explicit authorization. If the manager sees a fleeting arbitrage opportunity, they have to pick up the phone, track down the client, explain the trade, and get a yes before they can act.
That sounds incredibly inefficient if you are dealing with fast-moving markets. Like, what if the client is on a flight to Dubai?
It is inefficient. It introduces massive friction. Now, contrast that with a discretionary mandate.
Where they do have the power.
Yes. In this setup, the client and the manager sit down at the beginning of the relationship. They establish a comprehensive investment policy statement.
Kind of like a real book.
Exactly. It details risk tolerance, time horizons, liquidity needs, ESG preferences. Once that framework is signed, the client hands over the keys.
Wow, just total control.
The wealth manager has full discretionary authority to buy, sell, and rebalance the portfolio within the bounds of that policy statement without ever asking for permission.
I imagine wealth managers heavily push for discretionary mandates then.
Oh, they do. It allows for rapid tactical execution. And importantly, from the firm's perspective, discretionary mandates command a higher fee structure.
Naturally.
However, there is a significant psychological hurdle for the client here.
I can imagine. Letting go of $50 million.
Right. Many UHNW individuals are entrepreneurs. They built their wealth by being control freaks, by micromanaging every single detail of their business.
So giving up the reins is tough.
Convincing them to relinquish total control of their liquid net worth to a portfolio manager requires an immense amount of trust.
That makes total sense. It's a surrender of power. Now, moving beyond just managing the assets, we enter the realm of wealth planning and the specialized orchestration required.
This is where it gets really complex.
Yeah, the framework highlights that serving these clients requires an entire ensemble of specialists. We're talking lawyers, tax advisors, accountants, commercial bankers, investment bankers, specialized insurance brokers.
An army of experts.
I want to use an analogy here because it really clarifies the wealth manager's true function for me. The wealth manager isn't the first chair violinist. They aren't the virtuoso playing the tuba.
Yeah, they are the special.
They are the conductor of the symphony. They don't need to know how to personally draft a complex generation-skipping trust, but they need to know exactly when to cue the estate lawyer to draft it.
That is the perfect operational analogy. The wealth manager provides the overarching strategic vision, and the specialists provide the deep, narrow, tactical execution.
Okay, let's put this conductor analogy to the test with a really complex scenario mentioned in the curriculum: expatriation and relocation services, specifically focusing on golden visas.
Oh, golden visas are a prime example of this orchestration.
Let's say I'm an ultra-wealthy U.S. citizen, and for political, lifestyle, or tax reasons, I want to completely relocate my family and my assets to Spain. I want a golden visa. Walk me through the symphony. How does the wealth manager orchestrate this?
Well, it is a massive multi-year undertaking. First, let's define the instrument itself. A golden visa is a residency by investment program.
So buying your way in, essentially.
Basically, countries like Spain, Panama, and Australia offer foreign nationals residency and eventually a pathway to citizenship in exchange for a substantial capital injection into their local economy.
Like buying property.
Yeah, in Spain, for example, it typically involves purchasing real estate above a certain high-value threshold.
Okay, so the wealth manager cues the local Spanish real estate broker to find the asset. Seems easy enough.
That's just the overture. The true complexity is the collateral damage of the move.
What do you mean?
The U.S. has a citizenship-based taxation system, meaning they tax you on your global income regardless of where you actually live. If you are moving to Spain and want to sever your U.S. tax residency by renouncing citizenship, you will be hit with a massive U.S. exit tax.
Wait, really? An exit tax?
Yes. It's essentially a capital gains tax calculated on all your unrealized global assets, as if you sold them the day before you left.
Wow. The U.S. government makes sure they get their cut on the way out the door.
Exactly. So the wealth manager must cue the U.S. tax specialist to calculate and try to mitigate that exit tax.
Okay, cue the tax guy.
But wait, you also own a private equity firm in the U.S.? You need to liquidate your stake to fund the Spanish real estate and pay the exit tax.
Right, I need liquidity.
So the manager cues the investment banker to structure the M&A exit for your firm. But here is where the conductor matters. The investment banker's timeline must perfectly align with the U.S. tax specialist timeline, which must perfectly align with the Spanish immigration lawyer's timeline for the golden visa application.
Oh, I see. It all has to happen in a specific sequence.
Exactly. If the investment banker closes the sale too early, the cash just sits in a taxable account. If the Spanish lawyer files the paperwork too late, you miss the residency window entirely.
So if one person is off tempo, the whole thing falls apart.
The wealth manager is the only person who sees the entire board. They ensure that the tactical execution of one specialist doesn't accidentally trigger a catastrophic failure for another.
It really is a symphony. And it highlights why these clients look offshore or cross-border in the first place. It's not just about, hiding money in the Cayman Islands like in a 1990s spy movie.
No, it's about regulatory arbitrage, political stability, and accessing global markets.
But all this highly specialized orchestration, this army of lawyers and bankers on retainer, it does not come cheap,
Not at all.
which pivots perfectly into the business model itself. How do these wealth management firms actually generate revenue, and how do they compensate the conductors?
Well, the revenue models in private wealth are far more lucrative than retail banking, but they are also under intense margin pressure right now from regulatory demands for transparency. Broadly speaking, a firm's revenues are bifurcated into recurring and non-recurring streams.
The recurring revenue is the holy grail, right? It's the predictable, stable cash flow that keeps the lights on.
Absolutely. Recurring revenue is primarily generated through variable fees based on assets under management, or AUM. This is the classic model.
So just a flat percentage of the pot.
The firm charges a percentage, say 80 basis points, or 0.8% on the total value of the assets they manage for the client annually.
Okay, let me push back on the AUM model for a second because something doesn't make sense to me.
And for it.
If I have $10 million with a firm, an 80 basis point fee is $80,000 a year. That seems reasonable for bespoke service, the lawyers, all of it.
Sure.
But if I have $100 million with the same firm, that fee scales up to $800,000 a year. Is the firm really doing 10 times the amount of work to manage the $100 million?
You are echoing the exact argument that many UH&W clients and family offices make today.
It just feels like the AUM model disproportionately penalizes the ultra-wealthy just for being wealthy, especially if a large chunk of that capital is just tracking a broad market index.
It's a huge point of contention and is driving a massive shift in the industry. You are entirely correct that managing $100 million does not cost 10 times more in overhead than managing $10 million.
So how do the wealth managers justify it?
To defend the AUM model, wealth managers argue that as AUM scales, the complexity scales non-linearly. A $100 million portfolio isn't just tracking the S&P 500.
What's in it then?
It includes highly illiquid alternative investments, direct private equity co-investments, and complex derivatives that require intensive due diligence and active risk management. They argue you are paying a premium for access to exclusive deal flow and that sleep-at-night factor.
But the clients are pushing back.
Heavily. Many UH&W clients are demanding tiered fee structures where the percentage drops as the AUM crosses certain hurdles.
Like bulk pricing.
Exactly. Others are pushing for flat retainer fees for advisory and administrative services, completely decoupled from the size of the portfolio.
Makes sense. And what about the non-recurring revenue?
Non-recurring revenue comes from transactional friction or highly customized one-off project work.
Give me an example.
If a client is going through a hostile divorce and requires massive asset restructuring and forensic accounting, that generates a massive one-time fee.
Right.
Or if a patriarch dies and the firm has to execute a sprawling multi-jurisdictional estate transfer, that's a one-time fee. It's highly lucrative, but impossible to forecast accurately.
Okay, so the firm is generating all this revenue. Now let's look at how they distribute it to their employees, the wealth managers themselves.
The compensation structures.
The curriculum outlines 4 primary components of compensation: fixed, variable, long-term incentives, and fringe benefits. Now, fixed compensation is obvious. It's the base salary.
Right.
But the variable compensation, the annual bonus, is where the structural tension of this entire industry seems to lie. The framework states that a firm's risk appetite dictates the ratio between fixed and variable pay. Explain that dynamic.
It's a really delicate balancing act. A wealth management firm that prioritizes extreme stability, capital preservation, and long-term client retention will have a low risk appetite.
So they don't want cowboys.
Exactly. Consequently, they will heavily weight their compensation toward fixed base salaries. They don't want their managers swinging for the fences to hit bonus targets. They want them providing steady, reliable service.
But what if you're a firm that wants to grow aggressively?
Ah, if a firm is in an expansionary phase, desperate to capture net new money and generate high returns to market to prospective clients, they have a high-risk appetite.
So they flip the ratio.
They will keep base salaries relatively low, but offer explosive, uncapped, variable bonuses tied directly to the manager's financial performance.
Like how much revenue they brought in.
Exactly, or how much their portfolios outperformed the benchmark.
Which introduces a massive, glaring conflict of interest.
How so?
Well, if my bonus, my livelihood, and my ability to buy a house in Aspen are entirely dependent on hitting aggressive, short-term performance targets by December 31st, I am heavily incentivized to take reckless, asymmetric risks with my client's capital. If the high-risk biotech stock I buy goes up 300%, I look like a genius and I get a 7-figure bonus. If it goes to zero, the client loses their wealth, but I just lose my job. I don't lose my own money. It's a classic moral hazard.
You have articulated the exact structural flaw that contributed heavily to the 2008 financial crisis across the whole banking sector, the asymmetry of risk.
Heads I win, tails the client loses.
Precisely. The industry recognized this moral hazard, and more importantly, global regulators recognized it. They realized that you cannot allow individuals to privatize the massive gains of risky behavior while socializing the losses onto the clients or the financial system.
So how do they fix the asymmetry? Do they just cap the bonuses?
Capping the ratio of variable to fixed pay is one regulatory tool, and it's actually heavily utilized in Europe under frameworks like CRD-IV. But the more potent mechanisms are long-term incentive plans, or LTIPs, and clawback provisions.
Let's break those down. What is an LTIP doing mechanically?
An LTIP essentially forces the manager to eat their own cooking over a long time horizon.
Okay, how?
Instead of paying a massive cash bonus at the end of the year, a significant portion of the manager's variable compensation is deferred and awarded as equity in the wealth management firm itself.
So they get paid in company stock?
Yes.
Yeah.
Furthermore, that equity comes with a strict vesting period, often 3 to 5 years.
So it's a pair of golden handcuffs?
Precisely. If the manager takes reckless risks to boost this year's numbers, but those investments blow up 2 years later, damaging the firm's reputation and stock price, the manager's own deferred equity becomes worthless.
It aligns the manager's personal wealth with the long-term sustainable health of the firm and the client.
Exactly. It forces a long-term perspective.
And what about the clawbacks? Let's say the manager somehow manages to get the cash bonus, buys the house in Aspen, and then 3 years later it's discovered they engaged in massive fraud to hit those numbers. How does a firm actually get the money back?
A clawback provision is a contractual right built right into the employment agreement.
So they sign away the right to keep ill-gotten gains.
Yes. It stipulates that if subsequent investigations reveal misconduct, severe risk limit breaches, or that the financial performance was restated or fraudulent, the firm can legally rescind the bonus.
Mechanically, how do they get cash back if it's already spent on the Aspen house?
If the cash has already been dispersed, the firm can literally sue the employee for restitution. But more commonly, they simply seize any unvested deferred compensation to offset the loss. It acts as a severe deterrent against rogue behavior.
Okay, so we have mechanisms to curb reckless risk-taking. But the curriculum highlights few other, more insidious conflicts of interest that plague the industry.
Yes, behavioral conflicts.
Let's talk about churning. What is the mechanical action of churning?
Churning is a predatory practice that occurs when a wealth manager is compensated primarily through transaction-based fees or commissions rather than an AUM fee.
So they get paid per trade.
Exactly. Every time they buy or sell a security in the client's account, they get a cut. Churning is the act of excessively trading the assets in a client's account solely for the purpose of generating commissions for the broker, with absolutely no strategic benefit to the client.
It just bleeds the account dry with fees.
In fact, it actively harms the client through trading costs and potential tax liabilities. It is universally condemned and illegal.
But I imagine it's hard to catch.
Very. It requires vigilant monitoring to detect, because a broker will always try to justify the trades as tactical reallocation to take advantage of market movements.
Right. I was just doing my job. Then we have this term that sounds like a disease. Retrocessions.
Retrocessions.
What is a retrocession, and how does it compromise fiduciary duty?
A retrocession is, in plain terms, a hidden kickback or a referral fee. Let's walk through the mechanics.
Yeah.
A wealth manager advises a client to allocate $5 million into a specific third-party actively managed mutual fund. The mutual fund charges the client a 1.5% management fee.
Standard so far.
But behind closed doors, the mutual fund takes a portion of that fee, say 0.5%, and quietly kicks it back to the wealth manager as a reward for directing the capital to their fund.
Oh, wow. So the conflict is glaring. If I'm the client, I have to wonder,
Mm-hmm.
is my wealth manager recommending this mutual fund because it genuinely has the best historical risk-adjusted returns, or are they recommending it simply because it pays them the fattest retrocession?
Exactly. It completely shatters the illusion of objective, independent advice. It fundamentally corrupts the fiduciary duty to act in the best interest of the client.
So is this legal?
Because of this conflict, the regulatory landscape regarding retrocessions is highly fragmented. In the UK, Australia, and the European Union, under MiFID regulations, retrocessions for independent investment advice have been aggressively banned or severely restricted.
Regulators just decided the conflict was unmanageable.
Right. However, in the US and Canada, they are still broadly permissible, provided they are heavily and explicitly disclosed in the client's paperwork.
It's the classic regulatory philosophical divide. Europe bans the conflict. The U.S. says, just put it in the fine print and let the free market decide.
That's a very accurate summary.
And that perfectly segues into another massive conflict of interest, payment for order flow, or PFOF. We've seen this dominate the headlines with retail trading apps like Robinhood, but how does it impact private wealth?
Payment for order flow is the practice where a brokerage firm does not send client trade orders directly to a public exchange like the NYSE.
Where do they send them?
Instead, they route the orders to a third-party wholesale market maker like Citadel Securities. The market maker executes the trade and pays the brokerage firm a fraction of a cent per share for the privilege of executing that flow.
Wait, why would a market maker pay for the right to execute trades? Doesn't that cost them money?
Because retail and wealth management trade flow is generally considered uninformed.
Uninformed.
Yeah, it's not institutional hedge fund money trying to execute a massive market-moving block trade. The market maker knows they can comfortably take the other side of these smaller trades, capture the bid-ask spread, and make a consistent low-risk profit. They kick a portion of that profit back to the broker to ensure the broker keeps sending them the orders.
And the conflict here is the routing priority, right? As a client, I want my broker to route my trade to whatever venue gives me the absolute best price execution. But the broker is incentivized to route my trade to whichever market maker pays them the highest PFOF.
Exactly. It creates a tension between best execution for the client and broker profitability. Now, defenders of PFOF argue that this revenue stream is what allows brokers to offer zero-commission trading.
Which fundamentally democratizes access to the markets.
Right. They argue the fraction of a penny lost on execution is vastly outweighed by saving a $10 commission fee. But regulators remain deeply skeptical, constantly probing whether clients are truly getting the best end of the deal.
All of these conflicts churning, retrocessions, PFOF, reckless variable bonuses, they all point toward a central theme: the intersection of immense opaque wealth and basic human greed.
It's a potent combination.
Which brings us to the final and perhaps most critical segment of our deep dive: scandals, crimes, and the global regulatory response.
The dark side of the industry.
Yeah. And the curriculum makes it very clear that the architecture of modern financial regulation wasn't built proactively in a vacuum. It is entirely reactive. It's basically a fortress built from the ashes of spectacular failure.
That is the defining truth of financial regulation. Rules are written in blood and lost capital.
Right.
The private wealth industry operates in a matrix of voluntary ethical codes, like the CFA Institute Asset Manager Code, the AMC, and the Global Investment Performance Standards, GIPS, and hard statutory law.
So voluntary codes first.
Yeah, adhering to the AMC establishes a baseline of fiduciary duty, and GIPS ensures performance metrics aren't manipulated. But when bad actors bypass these codes, the systemic failures force regulators to create hard mandates.
So let's examine the anatomy of these failures, starting with the undisputed king of financial fraud, the Bernie Madoff Ponzi scheme.
The biggest of them all.
Now, everyone knows Madoff ran a Ponzi scheme, paying early investors with the capital of new investors. But the CFA curriculum focuses on the mechanical vulnerability that allowed a $65 billion fraud to persist for decades without detection.
And it all comes down to one word: custody.
Let me use an analogy here to see if I have this right. Imagine a casino. In a highly regulated casino, you have the dealer who plays the cards, you have the pit boss who watches the dealer, and you have the state auditor who reviews the vault. What was Madoff doing?
In your analogy, Madoff was the dealer, he was the pit boss, and he essentially wrote the audit reports for the state.
Oh, wow.
He exploited a fatal flaw in the architecture of wealth management: self-custody.
Let's break down how a normal legal setup works first, just for contrast.
In a standard compliant setup, the roles are strictly bifurcated. You have the investment manager, they make the strategic decisions, they decide to buy Apple and sell Microsoft.
But they don't actually hold the money.
No, they do not physically hold the client's money. The physical cash and the securities are held by a completely separate, highly regulated, independent institution called a custodian, usually a massive trust bank.
Okay.
The manager sends trade instructions to the custodian executes and settles the trade, and crucially, the custodian generates an independent statement of holdings and sends it directly to the client.
It's an impenetrable firewall.
Yeah.
The manager can't steal the money because they literally never touch it. They just direct it.
Precisely. Furthermore, the custodian performs daily reconciliations. They verify that the assets actually exist in the depository.
So what did Madoff do differently?
Madoff, through his broker-dealer entity, acted as his own custodian. There was no independent third party holding the assets or verifying the trades. He cleared his own trades and generated his own client statements.
Which means he could literally just type whatever numbers he wanted into a Microsoft Word document, print it out, and mail it to billionaires.
Yes.
And there was no institution to say, hey, wait a minute, those treasury bonds don't actually exist in the vault.
Exactly. It was a failure of verification. He simply fabricated the trade confirmations and the account balances.
That's terrifyingly simple.
It was. And the global regulatory response to the Madoff implosion was swift and brutal. It forced a massive tightening of custody rules. Today, investment advisors are subjected to intense scrutiny and surprise audits if they maintain custody.
I would hope so.
And the industry norm has shifted overwhelmingly toward mandating independent, qualified, third-party custodians for all private wealth assets. The firewall is now a legal requirement in most jurisdictions.
So Madoff exposed the custody vulnerability. The next major scandal highlighted in the framework is the 1MDB scandal. This was the massive multi-billion-dollar embezzlement of a Malaysian sovereign wealth fund.
A truly wild story of international corruption.
What structural vulnerability did 1MDB expose in the private wealth ecosystem?
1MDB was a masterclass in the weaponization of the global banking system to launder stolen state funds. It exposed catastrophic systemic failures in anti-money laundering, or AML, compliance across top-tier global banks.
How exactly?
Well, the core vulnerability highlighted by 1MDB was the handling of PP's politically exposed persons.
Let's define a PP, because it's not just the president or the prime minister.
Yeah, it's broader. A P is defined as an individual who is or has been entrusted with a prominent public function. This includes senior politicians, high-ranking military officers, executives of state-owned enterprises.
And their families?
Crucially, yes. Their immediate family members and close associates are also considered PPPs.
Why are they treated differently?
The regulatory logic is that because of their proximity to state power and state coffers, PPs carry a significantly higher inherent risk of being involved in bribery, corruption, and the embezzlement of public funds.
So how does a wealth manager actually handle a PP? Do they just refuse their business entirely?
They don't refuse it because PPs are often legitimately ultra-wealthy. But the regulatory friction is immense. When a PP tries to open a private banking account, the bank cannot just do a standard background check. They are legally mandated to execute enhanced due diligence, or EDD.
What does enhanced due diligence actually look like in practice?
It means tracing the exact provenance of every single dollar.
Okay.
If a foreign minister's nephew tries to deposit $20 million into a Swiss account, the bank must comprehensively prove exactly how the nephew legally acquired that wealth. They must analyze their business interests, cross-reference global sanctions lists, and continuously monitor the account for transaction anomalies.
And what happened in the 1MDB case? Did the banks just not do this?
In the 1MDB case, billions of dollars flowed through global banks via complex webs of shell companies controlled by PPs and their associates, and the compliance departments either failed to investigate the true source of wealth or actively ignored the red flags to capture the massive fees.
Unbelievable.
The fallout forced regulators globally to mandate draconian AML procedures and actually hold individual banking executives criminally liable for compliance failures.
You mentioned shell companies just now, which perfectly sets up the third massive catalyst for modern regulation, the Panama Papers and the Paradise Papers.
The massive data leaks.
Right. These were unprecedented leaks of millions of confidential documents from offshore law firms. Now, we touched on offshore earlier when discussing golden visas, but let's dive deep into the mechanics of offshore secrecy.
It's a fascinating structural illusion.
How does an ultra-wealthy individual actually use a shell company to hide wealth, and how do these leaks change the game?
To understand the impact of the leaks, you have to understand the classic architecture of offshore tax evasion. Let's say you want to hide $50 million from your home country's tax authority.
Okay.
You hire an offshore law firm in a jurisdiction with strict corporate secrecy laws, like the British Virgin Islands or Panama. They create a shell company.
And what exactly is a shell company?
A shell company is a legitimate corporate entity that exists entirely on paper. It has no employees, no physical office, and conducts no active business operations. It exists solely to hold assets.
So I name it Host Speaker Holdings.
No, because that defeats the entire purpose of anonymity. You name it something innocuous, like Blue Horizon Ventures Ltd.
Okay, fair enough.
Then the offshore law firm provides what are called nominee directors. Essentially, local residents who are paid to have their names on the corporate registry as the official directors of the company.
Ah, so if an investigator looks up Blue Horizon Ventures, they just see a local lawyer's name. My name is nowhere on the public record.
Exactly. Furthermore, the shares of the shell company might be held by a discretionary trust located in yet another jurisdiction, say the Cayman Islands.
It's just layers upon layers.
Yes. You transfer your $50 million into the bank account of Blue Horizon Ventures. To the outside world, that money belongs to a BVI corporation controlled by local directors. But behind a wall of attorney-client privilege and corporate secrecy laws, you are the ultimate controller of the funds.
It's literally a matryoshka doll of legal obfuscation. So what happened when the Panama Papers blew the lid off this?
The leaks revealed the actual identities behind tens of thousands of these shell companies, implicating global leaders, celebrities, and billionaires in systemic tax evasion and money laundering.
The public outcry was massive.
Enormous. And the global regulatory response was a coordinated, aggressive strike against the concept of anonymity. The primary weapon deployed was the concept of the beneficial owner.
The beneficial owner, meaning the actual human being pulling the strings at the center of the doll.
Precisely. Regulators globally, spearheaded by organizations like the FATF, the Financial Action Task Force, began mandating the creation of beneficial ownership registries.
How do those work?
They declared that it no longer matters how many layers of trusts or shell companies you stack up. The financial institution opening the account and the corporate service provider creating the entity are legally obligated to pierce the corporate veil, identify the actual living, breathing human being who ultimately benefits from the assets, and report them to the authorities.
Wow. And this ties directly into what the curriculum calls the most lethal weapon in the modern tax regulator's arsenal, the CRS, or Common Reporting Standard.
Oh, the CRS changed everything.
The curriculum notes this as a watershed development. How did the CRS effectively kill traditional offshore banking secrecy?
Well, prior to the CRS, if you were, say, a resident of France trying to evade taxes, you could drive across the border to Switzerland, open an undeclared private bank account, deposit your gold or cash.
And it just rely on Swiss banking secrecy laws to ensure the French government never found out.
Exactly. If the French authorities suspected you, they had to formally request information from Switzerland, proving they already had evidence of a crime, which is a massive procedural hurdle.
It was a game of cat and mouse, where the mouse had an impenetrable fortress.
The CRS inverted that entire paradigm. Designed by the OECD, the Common Reporting Standard mandates the automatic exchange of financial account information between participating jurisdictions.
Automatic. So it removes the need for suspicion or formal requests.
Entirely.
So how does it work today? Let's run that same scenario with the French resident.
Today, if that same French resident opens an account in Switzerland, the Swiss bank is legally obligated, under threat of massive international sanctions, to automatically package up the client's name, their beneficial ownership data, their account balances, and their interest income, and digitally transmit it to the Swiss tax authority.
And then the Swiss authority just hands it over.
The Swiss authority then automatically routes that data package directly to the French tax authorities on an annual basis.
It's completely automated surveillance of cross-border capital. The era of the secret numbered Swiss bank account is effectively dead.
It is entirely legislated out of existence. The global shift is aggressively toward total transparency and seamless information flow between sovereign tax authorities.
So we have FATF setting the AML standards and the CRS enforcing tax transparency. The curriculum also mentions IOSCO. What is their remit in this matrix?
IOSCO is the International Organization of Securities Commissions. It is a massive association uniting the securities regulators from over 120 jurisdictions, including the SEC in the U.S. and the FCA in the UK.
Do they write laws?
They don't write binding laws, no. But they set the global principles for securities regulation. Their core mission is to protect investors, ensure markets are fair and efficient, and most importantly for wealth management, reduce systemic risk.
How do they do that without writing laws?
By coordinating regulatory approaches across borders so bad actors can't just engage in jurisdictional arbitrage like moving from a strict country to a lenient one just to commit fraud.
Closing the gaps between countries.
Yeah.
We also have to navigate region-specific heavyweights. Let's look at, the acronyms here are a mouthful. AIFMD, UCIDES, and MiFID 10.
Europe loves its regulatory acronyms.
Let's break these down, starting with the funds.
Right.
What are AIFMD and UCITES?
AIFMD and UCITES are the twin pillars governing fund managers in Europe. AIFMD, the Alternative Investment Fund Managers Directive, was actually born out of the 2008 crisis.
Okay.
It regulates the managers of alternative investments, hedge funds, private equity, and real estate funds. It focuses heavily on monitoring leverage, ensuring these highly complex funds don't introduce systemic risk to the European banking system.
And UCITES?
UCITES is the gold standard for retail funds. If a mutual fund is UCITES compliant, it means it adheres to incredibly strict rules regarding liquidity, diversification, and asset eligibility. A UCITES fund cannot suddenly lock up investor capital. It must provide regular liquidity.
Good to know. And then there is MiFID 2. The Markets and Financial Instruments Directive. I know from reading industry press that MiFID II was viewed as an absolute operational nightmare for wealth managers when it was implemented. Why did it cause so much friction?
Because MiFID II fundamentally re-engineered how financial products are distributed and sold in Europe. It instituted massive binding requirements surrounding suitability and transparency.
Suitability meaning?
Well, prior to MiFID II, a wealth manager had more leeway to sell complex, high-margin products. Under MiFID II, the manager must rigorously document and prove that every single product they sell is mathematically and fundamentally suitable for that specific client's risk profile, knowledge level, and capacity to absorb loss.
So they can't sell a highly leveraged, complex derivative to an elderly client who just wants capital preservation, even if the client explicitly asks for it.
Exactly. And the documentation required to prove suitability is monumental. Furthermore, MiFID II forced the unbundling of research costs.
What does that mean?
Historically, investment banks would provide free research reports to wealth managers, and in exchange, the wealth manager would route lucrative trade execution business to the bank.
A little quid pro quo.
Right. MiFID II outlawed this, arguing it was a hidden conflict of interest. Now, wealth managers must explicitly pay for research out of their own P&L or charge the client a highly visible separate fee.
That must have crushed the margins of the research industry.
It did, and it forced immense operational transparency on wealth managers.
And looking across the Atlantic, the U.S. regulatory framework is similarly tightening the screws, primarily through the SEC. The foundational bedrock is the Investment Advisors Act of 1940, which established the fiduciary duty, the legal obligation to put the client's interests above the firm's.
The cornerstone of U.S. advisory law.
Right. But the curriculum specifically highlights the SEC's 2023 rules for private fund advisors. What was the catalyst for these new rules?
The SEC recognized that private funds, hedge funds, private equity, venture capital have ballooned into a multi-trillion-dollar industry. And increasingly, the capital flowing into these funds isn't just from billionaires.
Who else is it from?
It's from pension funds and university endowments, meaning regular people's retirement money is caught up in them. The SEC's 2023 rules were a targeted strike against the historic opacity of those private funds.
So what do the rules demand?
They demand stringent, standardized disclosure of all material facts. Fund managers must provide detailed quarterly statements on performance, fees, and expenses.
And they can't play favorites anymore.
Exactly. They are heavily restricted from offering preferential treatment like special liquidity terms or hidden fee discounts to certain favored investors unless it is explicitly disclosed to all investors. It is an aggressive push to democratize the data within the most secretive corners of finance.
So, synthesizing all of this,
hmm
from Madoff's self-custody to the CRS automating tax surveillance to MiFID II demanding absolute suitability, what is the net result? If you're a wealth manager operating today, are these regulations actually preventing the next systemic crisis, or have we just paralyzed the industry with an insurmountable mountain of compliance paperwork?
It is the defining tension of modern finance. I mean, there is no denying that the compliance burden is staggering. A massive percentage of a private bank's operational budget is now entirely consumed by legal teams, AML software, and regulatory reporting.
It's a huge drag on profitability.
It is. The barrier to entry for starting a new wealth management firm is incredibly high purely because of the compliance costs. But if you look at the architecture objectively, the structural vulnerabilities that allowed a Madoff to thrive have been decisively dismantled.
The self-custody loophole is closed.
Right. And the blatant systemic tax evasion facilitated by offshore shell companies, exposed by the Panama Papers, is exponentially harder to execute today because of the CRS.
So the system is actually safer.
The friction is undeniable, and managers hate it, but the baseline security and transparency of the global financial system have been fundamentally elevated.
It is an incredible evolution. We have journeyed through the entire architecture of an industry that operates largely out of public view. Let's just briefly recap the sheer scale of what we've unpacked in this deep dive into the CFA private wealth framework.
It's been a journey.
We started by dissecting the wealth hierarchy, identifying that the true hallmark of the ultra-high net worth client isn't just the $50 million. It is the staggering, multi-jurisdictional legal and tax complexity that surrounds it.
The Gallaghers.
The Gallaghers, exactly. We explored the conductor model, mapping out how a wealth manager orchestrates a sprawling symphony of tax lawyers, expatriation experts, and investment bankers to execute bespoke strategies like golden visas and Lombard loans.
We also pulled apart the business model itself, analyzing how the tension between stable AUM fees and aggressive variable compensation creates inherent moral hazards.
And we examine how the industry attempts to leash human greed through long-term incentive plans and clawbacks, while battling those persistent conflicts like churning, retrocessions, and PFOF.
And finally, we traced the reactive evolution of global regulation, watching how the ashes of Madoff, 1MDB, and the Panama Papers were forged into the ironclad compliance frameworks of independent custody, AML-enhanced due diligence, and the automated transparency of the CRS.
It is an industry caught in a profound transition. It's constantly balancing the highly bespoke, deeply private needs of the world's wealthiest individuals with the relentless, unyielding march of global regulatory transparency.
And that transition is only going to accelerate as technology continues to commoditize the purely mathematical
Final, somewhat provocative thought for you to mull over as we wrap up this deep dive. We discussed how algorithms and robo-advisors are ruthlessly efficient at optimizing asset allocation. As artificial intelligence becomes exponentially more sophisticated, capable of parsing global tax codes and analyzing multivariable risk matrices faster than any human, the purely mathematical value of the wealth manager will inevitably approach zero.
It's a real possibility.
If the algorithm can perfectly hedge the portfolio and optimize the tax harvesting, what is the wealth manager actually selling? The true value of private wealth management in the future might not be in growing the wealth at all. It might purely be in their human ability to manage the psychology of abundance.
That's a profound shift.
It will be the diplomacy required to mediate succession disputes, the empathy to handle the guilt of inherited wealth, and the discretion to manage the physical and reputational security of a family dynasty. What happens to the industry when the ultimate, most expensive luxury service isn't financial execution, but deeply, fundamentally personal guidance? Because when that $50 million wire hits the account, it's not a better spreadsheet you need, it's a guide through the psychological labyrinth. Thank you for joining this deep dive, and keep questioning the complex systems operating just out of plain sight.